Hey everyone, and thanks for jumping back into the Macroverse. Today, we're going to talk about the FOMC meeting that occurred earlier today. Talk about a little bit about what Powell said, expectations now going forward for interest rates, and maybe look at a few other things. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and check out the sale on Into the Cryptoverse Premium at intothecryptoverse.com. Let's go ahead and jump in. So I know that the FOMC videos are a little bit dry, but I do think it's important information to consider. So essentially, the Fed has kept interest rates, surprise, surprise, unchanged again. And if you were to go take a look at the Fed funds rate, I mean, you can see that we are now many months into this. And in fact, March will be our 8th month. And the next meeting is actually in March. Now, the reason why that's important is because I believe the median number of months that the Fed has historically paused for after a rate hiking cycle has been 8 months. And so there has been speculation that if we play this cycle out, on average, or sort of the median time frame, people I think we're sort of hopeful that we might actually get a rate cut in March. But I want to talk a little bit more about this, the release here first. And one of the things that they said was that the committee does not expect it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably toward 2%. Now, this is it's sort of a vague comment in some regards, because it's like, well, what does that mean exactly? Like, what other measures of confidence do you need? And in fact, this was asked to him. And essentially, what Powell said was that what they're seeing right now is what they need to see. They just need to see more of it, right? They need to see it continue to play out like that for a while longer, because, and let me find the quote that he said. He said, "We know that reducing policy restraint too soon or too much could result in a reversal of the progress we have seen on inflation and ultimately require even tighter monetary policy to get inflation to 2%. Reducing policy restraint too little or too late or too little could unduly weaken economic activity and employment." So to me, it still seems like they view one of the main risks as inflation not durably getting back to their 2% target. And when pressed about whether he thought inflation could reaccelerate, which I do think is a valid question. And I think one of the reasons, it is a valid question is if you were to go look at inflation year over year, I mean, you will very quickly see that there is a period in the 1970s where we had several peaks of inflation, just one after another. And in fact, after the first peak, it came back down to around 3% headline inflation, which is where it is today. And rather than continuing down to their 2% objective, you can see that it actually went back up. And what's interesting is it took a very long time to actually get back to their 2% objective. You can see that they left 2% back in really the mid 1960s, and headline CPI did not get back below 2% or even around 2% until 1986. So this is the danger that Powell is trying to avoid. And I mean, I think it's a reasonable view to have. They're worried that if they pivot too quickly and go back to looser monetary policy, that they're just going to get another wave of inflation. And he said that, right? He said that we have 6 good months. We have 6 months of good inflation data, but that's not sufficient for them, right? It's not sufficient for them to pivot at this point. And one of the things that I know a lot of people were thinking about and discussing was whether there would be a rate cut in March. And over the last month, there has certainly been a lot of investors thinking that there would be a rate cut in March. But Powell actually said, and I quote, "I don't think it's likely that the committee will reach a level of confidence by the time of the March meeting to identify March as the time to do that," in reference to the timing of the first rate cut. And then he went on to talk about how it's not the most likely case that they cut in March. He said it's not their base case that they cut in March. And I think the reasoning is because March isn't far enough away for them to get a sufficient number of data points between now and then that would cause them to change their mind. I think the main thing that could cause them to change their mind between now and March would be if the labor market were to soften up a lot. But I have to imagine, and he has admitted as much, that he does sometimes find out about these jobs numbers ahead of time. I wouldn't be surprised if he already knows some of the data that will come out later this week, because he did previously admit to sometimes getting sort of a tip off on it, especially with such a major decision as monetary policy in the United States. Sounds reasonable to me. So maybe he knows where the labor market data is going to come in for the rest of the week, and perhaps he still views the risk with inflation as the thing to be concerned about, right? I mean, and they do go on. I mean, he does go on to say that like they acknowledge that if they act too late, they could it could lead to sort of inflation reaccelerating, and then to have to go to tighter monetary policy. Take a look at interest rates back, many years ago, many decades ago in the 1970s. And what you'll notice is that, interest rates first went up to around 13%. That sounds kind of crazy, right? 13%. I mean, we're freaking out today over 5.5%, but it's the rate of change, right? I mean, it started out, right? It started out at 3.5% in 1972. And by 1974, it had reached 13%. But what happened? This was in 1974. The Fed eased too soon, 1974, and we just got another round of inflation going into the 1980s, where they had to raise rates all the way up here. Now, I want you to think about how painful that would be in this cycle, right? I mean, I know if you think about it, you go to you go out to a restaurant, you go to the store, whatever you're doing, and you're spending money. And just think about how expensive things are compared to where they used to be just a few years ago. I mean, I don't know about you guys, but I can't go to the grocery store anymore without spending twice what I used to spend. So it's great that, asset prices go up sometimes, but, if asset prices go up 2x and everything that you purchase in this world is 2x more expensive, where have we really gone, right? It's just everything's been inflated. So think about how painful it would be if we experience something like this, where you get a round of inflation, and so this is interest rates, right? Where you get a round of inflation and interest rates go up, and then the Fed pivots because they see inflation coming back down, right? And if you look closely, you'll see that they started to cut rates here in the summer of 74. Now look at the summer of 74. The summer of 74 was right up here, right? They started to cut rates. We were in a recession. And inflation came down thanks to the recession, right? Recessions are really great for bringing inflation back down. The problem is 1976 came and inflation just hung out at 5% in 1976. And the Fed was not raising rates in 1976. And you can see that they had to start raising rates again throughout 1976, 1977, 1978, 79, as inflation started going up aggressively again. Now, I know a lot of people, the whole monetary policy stuff can be kind of boring, kind of dry, but that is why it's such a big deal, is because what happens if they pivot too soon? I mean, I know a lot of people want them to pivot to go back to, to looser monetary policy. But the problem is, if you go back to looser monetary policy too quickly, it could lead to inflation coming back. And actually, look here in the 1970s, after this first peak where inflation came back down to about 3%, which is where it is now, you can see that it after going back down to 3%, the stock market went up a little bit more, but then the stock market crashed as inflation soared again. So sometimes you have to be careful what you wish for when thinking about rate cuts, because if they pivot too soon, they run the risk of another wave of inflation, right? I mean, sort of the animal spirits come out and everyone wants to spend money and invest in everything. And that's where things can get dangerous if sort of the frothy stuff comes back too quickly, and then we just get another round of inflation. And then, then the Fed has to go even higher. Speaking of, I don't know if you guys remember, but well over a year and a half ago, we suggested that the terminal rate this cycle would likely be 5.5%. This was back when it was at 1 or 2%. Back then, it was not seen as a likely outcome by many that they would go that high. But Powell did confirm today that he said that they do think they've reached their terminal rate for this business cycle. I mean, I think that makes sense. I don't really think they need to go any higher. I think what they need to do is they need to hold here long enough to make sure that inflation is brought back durably to their 2% target. So a lot of interesting stuff. And again, you might wonder, how does this matter to me as an investor, right? Why should it matter? And it all goes back to sort of what assets are safer, right? Which ones do better during environments like this? And I'll again remind you, right? It's sort of the higher market cap stuff, right? The companies that have healthier balance sheets, money tends to flock to those, right? You've heard the Magnificent Seven, and one of the reasons why companies like Apple and Google and or Alphabet and Meta, Microsoft, right? One of the reasons, Nvidia, one of the reasons why those do so well is because they have a lot of cash on hand, right? I mean, they have good business models too. They have a lot of cash on hand. And so even if the Fed were to raise, even if the Fed were to hold rates here for a year, there's still a good chance, a great chance, right? More than just a great chance, right? But there's a really, really high probability that all of those companies will survive, right? They could survive way more than just the Fed keeping rates at 5.5% for a couple of years, okay? So when you're an investor and you're thinking about, well, where do I put my money? Do you go put it in a well-known company, right? Like one of the major tech stocks that you're pretty confident will still be here next business cycle? Or do you take the risk and put it in some micro-cap business that may or may not survive, right? And so what a lot of investors decide to do, rather than invest in smaller market cap companies that maybe they don't have the best balance sheet because they just haven't had time to grow to the size of Apple, or they don't have the same type of innovation. But you get the idea, right? A lot of these companies, they're a fraction of the size of these larger mega cap tech companies, and there's no guarantee they're going to survive until the next business cycle. It all depends on how long the Fed keeps rates at 5.5%. I'm sure you've seen all sorts of charts on Twitter or X showing the number of delinquencies rising, the number of bankruptcies rising, right? So we know that's happening, and that's one of the reasons why the Fed has to keep a close eye on things, because if they hold too long, then that sort of stuff can move up exponentially, right? And that's what's happened previously. If they hold rates too long, then the economy sort of tilts into a slowdown. And then when you cut rates 25 basis points, it's not going to do a thing. I mean, you'd have to cut several hundred basis points to have a material effect on the economy. I mean, think about it. Think about all the small businesses out there right now that are struggling. And maybe some of you watching this video own your own small business, and maybe you've seen sales slow down this year compared to, say, last year or the year before. Is a 25 basis point rate cut going to magically solve things? Probably not. But 200 to 300 basis points of rate cuts probably could solve a few problems. If you think about it, if you're in the market to buy a car, a lot of people are turned off from buying a car right now because of how high rates are, right? If you go buy a used car or a new car and you get a loan, rates are so high that a lot of people get scared into doing so. But if rates came down, 200 to 300 basis points, then they might not be willing, or they might be more willing to go out and do that. And so that's kind of what's happening, is that we've reached this level of monetary policy that Powell says is in the restrictive zone, well into the restrictive zone. And it's just a matter of how long can they hold here before they need to go back to looser monetary policy. So again, how does it affect you as an investor? Well, the higher risk stuff bleeds to the lower risk stuff, right? And if you think about it, look at what happened today. The S&P 500 was down 1.6%, right? The Russell, was down. I mean, let me pull it up on because it's already showing sort of recent moves. If you look at the Russell here, this is the Russell 2000 ETF. It dropped almost 2.5%, right? So I think a lot of the smaller cap stuff didn't really like to hear that the March rate cut might be off the table, because I imagine there's a lot of people that are really hoping that we get a rate cut in March to help loosen up monetary policy, to get people more interested in spending money and maybe taking out loans to buy things like cars or houses, whatever it might be. So, but a lot of the smaller cap stuff didn't like what Powell had to say, and you can kind of, if you look at sort of the like a minute chart, which we don't often do, you can see just how crazy it was. Sort of he opened up, and early on it was still, I think markets were still hoping that there would be a March cut, and then when he was specifically asked about it, he basically more or less took it off the table. It's not entirely off the table, but he basically closed the door on that idea unless something catastrophic were to happen in the labor market. And basically once he said that, you can see that the smaller cap stuff really sold off pretty hard, because that lifeline of that QE drug of the dream of going back to looser monetary policy, lower interest rates, and money printing was sort of taken off the table. And a lot of the smaller cap stuff didn't like that. And the same stuff goes to the other asset classes. I'm not going to even mention it. I think it'll do some eye rolls, but you guys know what I'm talking about. It's that the higher risk stuff bleeds to the lower risk stuff, right? And think about it. Like, look at the S&P 500 over the last year or so, and look at what it's done. Now look at the Russell, smaller cap stuff, right? Haven't really gone anywhere. The market gets excited about potentially getting a rate cut, and then it's taken away, right? Russell hasn't gone anywhere. It's still where it has been. It was at the same valuation in May of 2022. It really hasn't gone anywhere in about a year and a half. And the companies are they're trying to hold on. They're trying to wait out the storm. It just depends on how much longer it's going to take. So again, inflation still relatively high, but arguably there are some good signs. If you were to look at PCE, price index inflation year over year, it's actually back down to 2.6%. So it is getting close to their target. It's not like it's that far away. It is getting a lot closer. Here's core PCE. I believe it was 2.9. Yeah, 2.9%. So it is getting closer. But they might need, more than just February's inflation data and March inflation data to sort of lower rates. And if you look at market expectations, let me go ahead and reload this, see where it stands now. It looks like Powell's words did have some effect, because there were certainly higher probabilities of a rate cut beforehand. Now it's about a 65% chance of the market thinking that they hold rates at 5.5% in March, and about a 35% chance that they cut. Still, the market thinks they'll cut by May, because there's only about a 6.8% chance that they hold rates in May, at that level in May as well. So market thinks there's going to be some type of a cut between now and May, but we'll see if that changes, because once upon a time the market was convinced of a March rate cut. They've actually said, if you look at like the summary of economic projections, the SEP, the committee members think there will only be 3 rate cuts this year. That's what a lot of people wrote out in the SEP, which is completely different than what the market is saying. The market is saying, no, you're going to cut 6 times this year, 6 25 basis point rate cuts. I think, again, I've talked about this before. I think we're seeing a bimodal distribution here, where there's some people that are, there's some investors that say, yeah, 3 rate cuts, and then there's other investors that are saying, no, hard landing, it's going to be several hundred basis points of rate cuts, and therefore you get something that's sort of in between. So you're probably not going to get this outcome. You're probably not going to get sort of the either extremes, but it'll be something in between. Okay, so it'll be interesting to see how this evolves over the next couple of months, because it's changed a lot. And one of the things that Powell said was that while the supply of he basically said that the supply of labor, let me see if I can get the quote. Um, Labor demand still exceeds the supply of available workers, right? And if you're not familiar with what he's referring to, if you look here, this is job openings divided by the unemployment level. So it basically shows you the number of openings, the number of job openings per unemployed worker. And the ratio has slightly climbed again this month to 1.44. So that implies that for every unemployed worker, there's 1.44 job openings. Okay, so, and I believe he said, right, it hasn't even reached the pre-pandemic level yet. And he's right. I mean, pre-pandemic, this ratio was around 1.2. Now it's about 1.4. So we would need to see this come down quite a bit for it to, to get back to the 1.2 level. And if you're not, the two things that go into this, you have job openings, which I know a lot of people were freaking out because they actually went back up. I'm not sure why. I mean, it's been a stochastic process the entire way, right? Slightly moving down with some up months in between. And then if you go look at unemployment level, it's been slowly rising, right? It's been slowly rising, but this last month it was relatively steady. But again, if you were to take like a 3-month moving average, it has been slowly going up, and then the last couple of months it's been declining a little bit, which is one of the reasons why when you go look at the job openings per unemployed worker, you can see that while it was previously in a downtrend, and it still probably is, there's been a couple of months here where it's sort of slowly gone back up. So by the March meeting, which is on March 20th, we'll have 2 more data points, right? We'll have 2 more data points. We'll see if this ratio is even lower, if it's more in line with the 1.2. We'll see where the unemployment rate is, if it's still at 3.7 or 3.8, or if it's marching north to 4%. We'll get a lot more data between now and then, but Powell is basically saying, look, unless the labor market really softens up, which he was asked about. He said, someone asked if there's a lot of issues in the labor market, will that cause you to cut? And he said, certainly that would weigh a lot. Only, 2 more data points in all of these different categories, right? The unemployment rate, headline inflation, core inflation, all that stuff. 2 more data points between now and March. They're not confident. Powell's not confident that those 2 data points will be sufficient for them to argue that we're going to get a cut. And if you think about it, if they've written out 3 cuts this year, if they've written out 3 cuts, they probably wouldn't want to front load them. Because if you do, the more you front load them early in the year, the less you have later on to potentially cut in case things really start to get bad, right? And also if they cut too soon, think about how bad optically it would be if they cut 25 basis points and then waited for 3 months and then inflation went back to 4 or 5%. Think about how bad that would be if they just cut 25 basis points and then a couple months later they just had to raise it right back up. Markets would not like that. Business owners would not like that. They really want to avoid a situation like the 70s, and this is what they've done. And it's kind of funny because I think that they've advertised pretty well. There's been a couple of flukes here and there. They've advertised pretty well exactly what they're going to do, and it seems like the market just hasn't believed them. Just like they've advertised 3 rate cuts this year, but the market thinks there's going to be 6. If you go back and look actually at the sort of the last business cycle, what's interesting is that in 2019 they cut, I believe it was, sorry, this is not working, I believe it was 3 times. Was it 3 times? So you have 1 cut, so it went from 2.5% to 2.25, right? And they held steady, and then they got 2 more cuts in 2019, right? So they cut in July, in September, and October. July, September, and October. And now, this cycle, they've basically taken March off the table, right? Basically taken March off the table. So that means the earliest cut, if that's true, is all the way out in May, which would then put the sort of the pause at 10 months. And again, remember the median is 8. That would put it at 10 months. So if they do cut in May and they only want to cut 3 times, if they cut in May, then that means 2 more cuts at the 5 meetings after that. So maybe they would cut in May and then again in July, and then again in November to spread it out. But again, there's no guarantee they cut in May, right? And what if the labor market still proves resilient even that far out? I don't know. I mean, May, you're going to have February, March, April labor market data. You probably won't have all the May data because the meeting's actually on May 1st. But it's certainly a lot to think about here and how the Fed's going to navigate this. And again, I know as an investor, you're like, how does this matter to me? It all goes back to what assets outperform the most during QT and during rate hiking cycles and times when the Fed has paused rates. There's one way to think about this, right? Like, look at Bitcoin. I'm going to talk about it. Look at Bitcoin. And I want to overlay Ether Bitcoin. What do you notice about Ether Bitcoin and Bitcoin uptrends, right? There's two distinct types. And you can see them clear as day, right? I mean, you have this uptrend here by Bitcoin where ETH Bitcoin went down. But that was also during a period of tight monetary policy, right? Tight monetary policy during a pause and higher interest rates, right? Bitcoin went up in the face of it, but the Ether Bitcoin valuation went down, right? The ETH Bitcoin valuation went down. Then you had a Bitcoin uptrend when ETH Bitcoin went up. That was during QE and looser monetary policy, right? When we went back to looser monetary policy. Same thing over here, right? We're at high, tight monetary policy. Bitcoin has gone up, but ETH Bitcoin has gone down, right? So this move here, I think, still resembles this one over here, where Bitcoin has been in this uptrend just like it was over here, but ETH Bitcoin went down during that period. Because why? Because higher risk assets bled to lower risk assets. Now, one of the questions that Powell was asked was, have we achieved a soft landing? What that really means, if you're not, what it means to me, and Powell said that they've not achieved it yet, right? It's too soon to celebrate. If you think about what that would mean, a soft landing is essentially where they get inflation durably back to target without pushing the economy into a recession, right? That's what a soft landing would be. A hard landing would be that they wait too long to cut rates and then the market just sells off, right? The market just sells off. And then all of the assets that were doing well, right? Like the juggernauts, right? Like the Apple and Nvidia and Microsoft, all that stuff, and even Bitcoin, right? In a soft landing, that stuff, well, it might go down, right? I mean, you can get normal corrections. It doesn't necessarily have to get a drastic correction, like this type of a correction, like a hard landing type correction. But a hard landing type correction is where the least risky stuff, right? The companies that people put their money in, those companies finally sell off. And if those companies sell off, then even the lower market cap stuff keeps selling off, even though they've already been smashed down so much. But then on the other side of that, you go back to looser monetary policy, and that's where the higher risk stuff starts to outperform the lower risk stuff. And so I think that's we're still in this transitionary period where, and again, I mean, the ETH Bitcoin chart is one example, but you could take a look at the Russell 2000 divided by, I mean, even the NASDAQ. It's the same thing, guys, right? It's the same thing. I mean, look at the Russell 2000 and the RTY NASDAQ valuation. It's been going down because higher risk, small market cap companies are bleeding to a lot of these mega cap tech stocks. How do you go back to a period where the higher risk stuff, the lower market cap companies start to outperform the NASDAQ? What happened over here where it turned around? We went back to looser monetary policy, and that's where those lower market cap stuff started to outperform the higher market cap stuff. So that is where, that's where we are. We've talked about this a lot. And that's why I think it's worthwhile to follow this as an investor, because monetary policy, it sort of dictates what assets, do better, right? Which ones tend to outperform. And the reason those outperform is because, and going back to crypto, right? I mean, people are pretty confident that Bitcoin will be here in 5 or 10 years, no matter what happens in the next year. Can you say the same thing about any random altcoin? No, probably not, right? I mean, if monetary policy were to stay tight for too long, then some of those would just die off. A lot of them would just die off because people would, move on to something else. Whereas, you know, Bitcoin will stick around, right? No matter what happens, more than likely it'll still be here in a few years, just like Apple will be here and Google. That's why people will focus on those things during rate hiking cycles, during QT, and that's why you hear things like the Magnificent Seven. Um, it's exactly because of that. Is because people focus their capital on the companies that have a far greater chance to survive whatever is going to come on the other side of rate cuts. But I think we'll wrap it up there. I know we've gone on a lot about where we are. Maybe there's one last thing. One interesting thing is like yields. The long end of the yield curve actually dropped quite a bit today. The 10-year dropped 3%, which is a pretty big drop for the 10-year. And you can see it was actually rejected off of the 21-week EMA. And so this is that whole idea of, perhaps this is the market saying, oh, crap, they're not cutting. That means, perhaps this is the way the market's telling us that, by the fact that they've taken the March rate cut potentially off the table means that the market's starting to worry more about, well, will some of this lower market cap stuff survive? And perhaps the risk now is not inflation, but whether you really start to slow the economy down. Because if the 10-year is falling, then it implies that inflation's not going to be as big of a deal. If the market thought inflation was going to be a big deal, then the 10-year would be going up because it would imply that we're going to have, there's going to be a lot of growth and reacceleration and all that stuff. But if it's falling, it implies that in the future, there's not going to be as much growth. If there were, then you wouldn't expect the long end of the yield curve to fall. It's the same thing, like when you think about prior business cycles, right? Like look at prior business cycles, you can see that, the 10-year goes up, right? The 10-year goes up for a while, and then at some point it falls back down as expectations change, right? As we chase the next narrative, right? Over here, the 10-year went up, and then in 2018, it started to go down as the market feared more so, is there going to be as much growth? So why don't we wrap it up there? We've talked about quite a bit. I think I've gone on long enough. Thank you guys for tuning in. Make sure you subscribe, give the video a thumbs up. And again, check out the sale on Into the Cryptoverse Premium at intothecryptoverse.com. I'll see you guys next time. Bye.